All right, this house in Snohomish, Washington is listed at $560,000, and I'm going to be talking about what it would look like to buy this place as a first-time home buyer, what your options are, and what your monthly payment might look like if you are coming in with kind of a lower down payment. I'm going to look at two different scenarios, one 5% down scenario and one a 10% down scenario. So I'll show you just some more concrete numbers than you might be able to get by just thinking about the house in the abstract or using an online calculator. So we'll look at your all-in cash, the cash you're going to have to bring. We'll look at the monthly payment that you'll likely be looking at, a rough monthly payment based on current market, current interest rates. None of these numbers will be exact dialed in because they're all dependent on your exact situation. And then the last thing we'll look at is, if that is the monthly payment, if that is your scenario, what income would it take to qualify for the loan amount that you're going to need? So we'll talk about those three things. This house is pretty rare price point in Snohomish. You can see it's a really neat house, and excited to look at what might be possible for first-time homebuyers coming to look at this place. So let's look at these quotes real quick. These are two different scenarios, and I think both of them are going to be helpful, even if you think, I'm coming in at 10% down for sure. I'm not doing 5% down, or vice versa. I think looking at both of them is going to be helpful to give you a picture of how your pricing is impacted with different down payments, and give you a sense of how the process works. So I'll walk through each separately, but I do think each will be informative for you. Let's look at these two quotes. I'll start with the monthly payment, which is the big number you see up top. And let's look at the numbers just real quick. So on the left, this is the 5% down scenario, and on the right, this is the 10% down scenario. And right away, let's just look at the monthly payment. So on the left, the 5% down scenario, you're looking at about $4,170 a month, and on the right, about $3,948 a month. So it's actually a very close number, even though it's a 5% difference. And I'll talk about why that might be in just one second. But before I do that, I'm gonna run through the numbers on each scenario. But before I do that, I'm gonna explain some of the assumptions I'm making coming into this loan. So you can see up top, I'm assuming you have a credit of 740, which mostly is going to impact your mortgage insurance, which I'll talk about in just a second. The better your credit as a first-time home buyer, the lower your mortgage insurance is going to be. I'm assuming you are a first-time home buyer. So for both of these, I'm assuming you're a first-time home buyer, which gets you access to this particular loan program that I'm using, which offers a little bit lower mortgage insurance than you might be able to find elsewhere. So I'm assuming you're a first-time home buyer. I'm assuming you have a credit of 740, and I'm assuming you have access to a pretty good pricing. I'm assuming that your income is below a certain point, and I'll talk about what the impact of that is in just one second. But those are the assumptions that I'm coming in that lead to the numbers that we're using here. So let's look at the 5% down scenario first. So you can see that the breakdown of the monthly payment is $41.70, and the breakdown is you've got homeowners insurance of $150 a month, and that's an estimate. Your number could vary. It could be above that, it could be below that. Just depends on your provider and the coverage you're getting. You can see the taxes are $357 a month, and both of those are dependent on the house. They are not dependent on the loan structure or loan type or anything like that. That's going to be the case regardless of which scenario you end up going with. And then we briefly touched on mortgage insurance of $124 a month, and mortgage insurance is a fee you have to pay if you are buying a house for less than 20% down. If the lower your down payment, the higher your mortgage insurance is going to be, but other things impact that, like I mentioned, like credit. And then the last component is just principal and interest, and that is based on this interest rate right here of 7%, which we are early March right now. This might not be the exact rate you'd get, certainly dependent on your circumstances and a lot of other things, but that's a broad rate that's in the ballpark of what you might look like in this scenario. So it's 5% down, which leaves you with a loan amount of $532,000. It's a 30-year term. You can see there are no points. Points are a fee you can pay up front in order to get a lower interest rate. Here I'm assuming no points. And so we've got closing costs coming in at $12,000. That's probably a little high. That's probably higher. We can dial in some things there. That's based on some assumptions that I'm making that are probably a little conservative, probably a little high, but it'll probably be in that $10,000 range if there are no other significant factors reducing that or increasing that. So closing costs about $12,000, and that plus your down payment is going to be $41,667 cash all in. That's all the cash you're going to have to bring to the closing table to be able to close this deal and get the house. That's including your closing costs and your down payment. So let's look over at the 10% down scenario and see how it's different. Now again, you look at the total monthly payment and it's $3,948. That's really close to the 5% down scenario. So we'll see why that is, and we'll look at what to think through there. But again, you are looking at insurance of $150 a month, taxes of $357 a month, and that is because those are dependent on the house, not the loan type, so those are not different from the 5% down scenario. Mortgage insurance of only $88 a month. And then you look at principal and interest, that's your last component, of $33.53. Let's run through the numbers of this scenario. Again, it's a $560 purchase price, 10% down, which leaves you with a loan amount of $504,000. And so this is a big part of why these two monthly payments are very similar. If you look at it, it's only a difference of about $30,000 spread over 30 years, and then divided by 12 months. So it's not going to account for that big of a difference. It's only a difference of $30,000 spread over 30 years. So then you've got the same. We ended up with the same interest rate of 7%. Again, same caveats apply. This is a broad rate. You'll be in this ballpark at this time in the market, early March 2024, but you won't necessarily end up with this exact rate. It's dependent on a lot of other things. No points here as well. Again, if you missed the previous one, points are a fee you can pay up front to get a lower interest rate. And then if you see this section here, credit is the opposite of that. Credit is a credit the lender will give you towards your closing costs in order to take a higher interest rate. And then we have total closing costs of $12,401.85. And sorry, that's closing costs. That's not your total cash to close. So again, closing costs are any other costs that you have to pay up front. That's a combination of a few different things. That's a combination of costs to get the loan, that there are parties involved that are doing work to help you get the loan that you have to pay. And then there are a general category of what's called prepaids, and those are not costs to get the loan. Those are costs that you will be paying on an ongoing basis, but generally you skip your first monthly mortgage payment because the lender needs time to get you set up in the system, so they take some of those fees from your first month and have you pay those up front, and some of those are included in closing costs. And then that leaves us with a total cash to close in the 10% down scenario of $69,516. So what income would you need to qualify for each of these scenarios? Generally, the way qualifying works is the lender takes what's called your debt to income ratio, and that needs to be less than 50% for you to qualify for a conventional loan like this. So your debt to income ratio is your total monthly debt divided by your gross monthly income. And again, that number needs to be less than 50%. And so that top number includes what would be your new housing payment. They take this hypothetical new housing payment, and they add that to any other monthly debts you have, your credit card debt, your student loan debt, car debt, whatever. They add that to any other monthly debts you have. And that's this top number. And they divide that by your gross monthly income. And this is important. It is the income that we are using on the loan. It is your qualifying income. And so, you might, when you're doing your budgeting at home, you might count more income than what's going to count here. You might count other side income that you have going on, or a spouse's income where they're working part-time variable hours that the lender wouldn't recognize, because there are certain standards that have to be met in order for the income to be counted in order for it to qualify for the loan. Usually if it's salary, it's pretty straightforward. It's going to qualify most of the time, but if it's variable or commission or anything like that, it needs to be seasoned typically, which means it needs time and consistency in order to prove to the lender that you could use it. So this is your qualifying income, and that's your income before taxes. So if we take that rule and we look at the 5% down scenario and we say this has to be this monthly payment, and we're assuming you have no other debts, this monthly payment needs to be less than 50% of your qualifying income. So if you're looking at your own situation, you could think about, okay, one spouse is salaried and the other just started a job and is part-time. Well, we'll probably just be able to use the salaried one. Or, maybe we can use some of this one because we've been doing it for a couple of years and it's proven and it's okay. So you can you won't really know until you can talk to a lender what your qualifying income is going to be. But as far as what the lender needs to see as far as what will qualify, if we take the rule that this total monthly payment, if you have no other debts, needs to be less than 50% of your gross monthly income, then your gross monthly income needs to be right about $8,340, and that's gross monthly for this 5% down scenario in order to qualify for that loan. Now, whether you're comfortable taking on that loan just because you make this amount, and if that's all you make, that's another question. That's a budgeting question. That's a finance question. But as far as qualifying, that's what it needs to be. And then for the 10% down scenario, qualifying, it would have to then be $7,000. All right, I'm going to break out the calculator for this one. As far as qualifying, it would have to be for this 10% down scenario, it would have to be about $7,916. $7,916 to qualify for this 10% down scenario, because obviously it's a little smaller monthly payment, so the income that it takes to qualify is a little lower. All right, I hope that's helpful. Again, there's a lot of assumptions, a lot of variables in there. It's best to get real numbers. It's best to get a real look at your financial situation to have a strong sense of what you could qualify for. Because again, there are lots of various rules that you just won't know what you're going to end up qualifying for until you end up talking to a mortgage advisor. So we'd love to help you. Obviously, my name is Landon Buteau. I work with Cleveland Street Mortgage. We're based in Bothell, Washington. We're licensed in Washington and Idaho, and we love taking on new loans, working with new clients. We work hard to serve as advisors and not just a loan store where we plug you into whatever we can qualify you for. Of course, we'll set you up with whatever you want, but we love to be able to provide helpful advice as well over a long-term relationship. So please do reach out. You can find our information in the description below. If you want to see what it's like to work with us first, there's a video linked that you can watch to see what our process is like, what it's like to work with our team. You can check that out in the description below. You can click that link and watch the video, or you can go ahead and go to our website. Our contact info is there. You can call, text, email, or schedule a call with us. We'd love to work with you.